Section 2, the appraisal phase. Appraisal phase is January 1st through May 15th. Learning objectives. At the conclusion of this section, students should be able to list and briefly describe each of the steps in developing the appraisal records. Explain the importance of situs in property taxation. Describe the function of exemptions. State amounts of homestead exemptions. Distinguish between the appraisal cap and the 65 or older or disabled tax ceiling. Distinguish among discovery, listing, and appraisal. Describe the requirements for notices of appraised value. This phase initiates the ad valorem property tax process for the year. All non-exempt property must be taxed according to its market value on the specified legal appraisal date, usually January 1st. The appraisal phase puts properties on the roll and attaches an estimated market value to each. This phase occupies much of the time between January 1st and May 15th each year. Overview, development of the appraisal records. Objective of the process is to develop an appraisal roll that taxing units can use to levy and collect taxes. The appraisal district prepares a list of all taxable property each year. The list is called the appraisal records until it is approved by the ARB. After approval, it is called the appraisal roll. Steps in developing the appraisal records. Discover property, list its characteristics, appraise the property, determine the property's situs where it will be taxable, apply exemptions for which the owner has qualified, send the owner an appraisal notice, and submit the records to the ARB. Discovery, listing, and appraisal. Discovery is identifying the property in an appraisal district, finding the property and determining who owns it, information sources such as regular field inspection, deed and other courthouse records, building permits, real estate professionals. Also taxpayer renditions, reports listing the taxpayer's property that are filed with the appraisal district. They're required for business personal property. Penalties are levied for failure to file in a timely manner and for fraudulent information. Listing is the act of recording classification, type, ownership, and property characteristics of properties. Information gathered for listing must meet two requirements: must be legally adequate so that taxes can be collected, and must provide sufficient information to be able to appraise the property. Updating characteristics of existing properties to account for changes that affect value, important part of any reappraisal effort, and regular inspection of all property is needed. Determining property type. Real property. Land and structures are attached to it. Improvements, buildings, and other structures attached to land. Legal interest in the above. Personal property. Items that can be owned but are not real property. Tangible, such as vehicles, inventories, and equipment. Intangible, not taxable, such as cash, bank accounts, goodwill, franchises, etc. State property classifications. Comptroller rules require the appraisal district to classify property in one of 12 real property classes: single-family residential, family residential, multi-family residential. Sorry, what did I say?
Family residential.
Family. Well, hey, that's multi-family. I said it twice. Sorry, I don't know what I was doing. Multi-family residential, vacant lots and tracts, qualified agricultural land, non-qualified land, farm and ranch improvements, commercial, industrial, oil, gas, and other minerals, farm improvements, utilities, and residential inventory. That's kind of like Little Caesars back up there, you know, family residential. Caesar. Sorry. Classes of tangible personal property are non-business vehicles, commercial, industrial, mobile homes, and other tangible personal property, and special inventory. How listed? Each appraisal district maintains a record that includes the characteristics of each property. Some maintain paper appraisal cards. Most use computers to store the records. Most appraisal districts maintain maps, paper or electronic, that are updated to reflect property splits and transfers. Some appraisal districts maintain digital photographs of the property as well. Comptroller Rule 9.3002A requires that each appraisal district have property tax maps, appraisal data. The property record includes the data necessary for the appraisal district's mass appraisal system. Necessary data varies with property type: site data, improvement data, and personal property data. The following reappraisal activities are required by law at least once every 3 years: identifying properties through physical inspection or other reliable means of identification, including photographs; identifying and updating relevant characteristics of each property; defining market areas. A market area is an area in which the properties are subject to the same economic forces; identifying characteristics that affect property value in each area; developing valuation models that reflect the relationship among property characteristics and determine the contribution of individual property characteristics; applying the conclusions of the appropriate model to the property characteristics; reviewing the appraisal results to determine value; estimating value using the mass appraisal techniques to place value on listed properties.
Okay.
Repeating number 4. Estimating value using mass appraisal techniques to place a value on listed properties. The chief appraiser's most important responsibility. Tax Code Section 25.18b requires reappraisal of all real and personal property at least once every 3 years. The appraisal date, property is usually appraised at its value as of January 1st of the tax year, with a few exceptions. Market value or special value. Most properties are appraised at market value. Market value is the price for which the property would sell in cash or its equivalent if the property held on the open market for a reasonable time. Buyer and seller know all of the uses of the property and restrictions on property's use. Neither party is under any compulsion or unusual pressure. Some properties may be appraised using specialized appraisal methods or different value standards. Examples of these include residential homesteads, owner-occupied homes, agricultural or timberland, special inventory, some types of deed-restricted properties. Minimum legal requirements for appraisal methods and procedures. Use of generally accepted appraisal methods. Similar techniques for similar properties. Consideration of unique characteristics of each property. Mass appraisal procedures must comply with uniform standards of professional appraisal practice, the USPAP. Let's see. Another legal standard for appraisal methods or procedures is considering all evidence specific to the property. If property value was reduced in an appeal in the previous year, determine whether substantial evidence supports increasing the value. Consider cost, market, and income approaches and use the most appropriate. Cost approach, estimate based on cost of replacing the property less depreciation. Comparable sales, the market approach, is estimate based on sales price of comparable properties. Income approach, estimate based on the amount of income the property is capable of generating. Mass appraisal, appraising large numbers of properties at the same time using valuation models. A valuation model is a set of formulas or tables that produce an estimated value based on the size and characteristics of the property being appraised. Valuation models are based on the approaches to value. Most appraisal districts use a combination of market and cost mass appraisal system. The appraisal district develops cost tables based on the square foot method of the cost approach, and then develops adjustment factors from sales of property. The appraisal district must use generally accepted techniques of specifying valuation models. Can use all three approaches to value. Must represent relationship between observable property characteristics and market value. Must use accepted techniques for calibrating models. Situs, determining where the property is taxable. What are you looking at me for? Did I mess it up?
No.
What did I do?
Nothing.
Situs is a Latin term referring to the place where property is taxable. A jurisdiction cannot tax property unless the property has some substantial contacts with the jurisdiction. The chief appraiser determines whether the property has situs in the appraisal district and in individual taxing jurisdictions. Real property is taxable if it is within a jurisdiction's boundaries. Property usually has situs and is taxable at its normal location or home base. If personal property has substantial contacts with two or more jurisdictions, special problems can arise because both jurisdictions may want to tax the property. Example, in one court case, a large piece of mining equipment called a dragline was operated on a lignite field that was on the boundary between two school districts. It was in both districts for substantial portions of the year. Both districts argued that they should have the right to tax it. Rockdale Independent School District versus Thorndale Independent School District, 681 Southwest 2D 225228, Texas App-Austin 1984, writ referred NRE. I have no idea if I read that right.
Yes, no big deal.
Personal property creates most problems because it can be moved from place to place. Real property situs issues are rare. Exemptions, reducing the tax liability for certain properties. An exemption includes all or part of property value from taxation. Generally, property owners are required to apply to the appraisal district for exemptions. The chief appraiser administers exemptions and determines whether to grant those exemptions. Key terms. Total exemption. Exemption that exempts all of the property from taxation. If all of the value is exempted from the property, it is not taxed. Example, Mrs. Smith's church receives a total exemption. The church sanctuary might be worth $500,000, but none of its value is taxable. Partial exemption exempts part of the property's value from taxation. If part of the value is excluded, the property is taxed as if it is worth less than its actual value. Example, Mrs. Smith's home is valued at $100,000. She receives a $25,000 general homestead exemption. Her property will be taxed as if it was worth $75,000, which is the $100,000 minus the $25,000. Lump sum exemption. A partial exemption that exempts a lump sum of value such as $5,000. A partial exemption that exempts a percent of value such as 20%. To calculate a percentage exemption, multiply the appraised value by the percentage. For example, 20% of $100,000 is $20,000. 100,000 times 20,000 equals $20,000. Mandatory exemption. An exemption that is mandated and taxing unit must offer this exemption. Local option exemption. An exemption the taxing unit may choose to offer in addition to any mandatory exemption. Appraised value can either be market value or value determined using another method of valuation according to Property Tax Code Chapter 23. Taxable value. Appraised value less applicable exemptions. How to calculate taxable value. Calculate the total amount of exemptions that apply. Percentage exemptions are subtracted from the appraised amount before lump sum exemptions are applied. Lump sum exemptions are added to the percentage exemption amount. Subtract the total exemption amount from the property's appraised value. Am I going on to E?
Yeah.
Exemptions for homeowners and families. Residence homestead applies to owner-occupied home that is the owner's principal residence. Basic types. General homestead exemptions may apply to all homes that qualify mandatory for school districts. 65 or older exemptions apply to the home of a person who is 65 or older. A home that receives the 65 or older exemption also receives a general exemption. Disabled persons exemptions will apply to the homes of persons who meet the definition of disability used for the purpose of payment of disability benefits under federal old age, survivors, and disability insurance. A home that receives the disabled persons exemption also receives a general exemption. A person who is both 65 or older and disabled must choose one of these two exemptions. The 100% disabled veteran's homestead exemption applies to a disabled veteran with a 100% service connection disability or is unemployable. The exemption applies to the full value of the property. The surviving spouse of a member of the United States Armed Forces who is killed in action receives a 100% exemption on their homestead property if the surviving spouse has not remarried. The surviving spouse may transfer the dollar amount of the exemption to a new homestead. The surviving spouse of a first responder killed in the line of duty is entitled to an exemption from taxation of the total appraised value of their residence homestead if the surviving spouse has not remarried. The surviving spouse may transfer the dollar amount of the exemption to the new homestead. A partially disabled veteran is entitled to an exemption equal to the disabled veteran's disability rating on his or her residence homestead if the homestead was donated by a charitable organization to the veteran at no cost. If a person receiving a 65 or older exemption dies, the person's surviving spouse receives the exemption if he or she is at least 55 years old. Homestead exemptions are mandatory for some taxing units and optional for others, and the amounts can vary. Homestead exemption savings can vary dramatically from taxing unit to taxing unit. Mandatory homestead exemptions. School districts must grant $25,000 for a general exemption, $10,000 for 65 or older exemption, $10,000 for disabled persons exemption. Counties must grant a $3,000 mandatory exemption against county farm-to-market flood control tax if they levy this tax. All taxing units must grant a 100% exemption to a qualified disabled veteran who is 100% disabled due to service-connected disability. The veteran must have a rating of 100% disabled or of individual unemployability and must be receiving 100% disability compensation. The exemption will pass to the veteran's surviving spouse if the surviving spouse has not remarried and the property was the residence homestead of the surviving spouse at the time of the veteran's death. The residence must remain the homestead of the surviving spouse. The surviving spouse of a disabled veteran who would have qualified for an exemption under Section 11.131 if the subsection had been in effect on the date the disabled veteran died, it is entitled to this exemption. A partially disabled veteran is entitled to an exemption on his or her residence homestead if the homestead was donated to the veteran by a charitable organization at no cost or not more than 50% of good faith market value. The exemption is equal to the veteran's disability rating and applies to all taxing units. For example, a 50% disabled veteran would receive an exemption equal to 50% of the appraised value of his or her homestead. The surviving spouse of a disabled veteran may transfer the exemption to a new homestead as long as the surviving spouse does not remarry. The surviving spouse of a member of the United States Armed Forces who is killed in action receives 100% tax exemption by all tax units on their homestead property if the surviving spouse is not remarried. The surviving spouse may transfer the dollar amount of the exemption to the new homestead. The surviving spouse of a first responder killed in the line of duty is entitled to an exemption from taxation of the total appraised value of their residence homestead if the surviving spouse has not remarried. The surviving spouse may transfer the dollar amount to the exemption of the new homestead. Optional homestead exemptions. Any taxing unit that has the option to offer a general homestead exemption of up to 20% of appraised value. This exemption has a minimum value of $5,000 if offered. A 65 or older disabled person's exemptions, or both in any amount of $3,000 or more. If school districts or counties offer optional exemptions, they are added to the mandatory exemptions these taxing units offer, with the exception that the county farm-to-market flood control exemption does not apply if the person receives a 65 or older or disabled person's exemption. A person who is both disabled and 65 or older must choose only one of these exemptions. Example: a school district has a mandatory $25,000 general homestead exemption and offers a 20% optional exemption. On a $100,000 house, the taxable value would be $100,000 less 20% equals $80,000, less $25,000 equals $55,000 taxable value. So 100,000 times 0.20 equals $20,000. 100,000 minus 20,000 equals 80,000. 80,000 minus 25,000 equals 55,000.